Reliance, because Jal, hi afternoon. Reliance is what broke the markets back on Monday, and we're seeing much a continuation of that trend. Another 2% knock coming in for Reliance today as well. Why the case, Jal?
So I'd say two reasons. Firstly, these are difficult times. The COVID recovery by no measure is complete, and whether it's for the refining sector or the retail sector, difficult times remain. So within that context, while Reliance has done very well, at the same time, that's weighed down things dramatically. But I think structurally and also very importantly, the disclosure levels, i.e. essentially for gross refining margins, isn't there. That is by far the refining business is the largest business. And Reliance, of course, for reasons that they do justify, which is that they want the market to look at fully integrated operations, right from oil to chemicals rather than the intermediate refining. But then by far refining is the largest business, whether it's an intermediate business or not. And to take that away from sort of 20 years of trends and analysis actually hasn't done any good at all from a disclosure level perspective. And the third thing I'd also say is that I think the market itself got ahead of got ahead. As you may recall, we downgraded Reliance about 6 months back because we really said that the market asked for the so-called new age business, the consumer-related businesses, is a 30% CAGR growth sustaining over the next 10 years, which is really the market was assuming that it's a given that it's gonna succeed. And the fact of the matter is actually whatever one may say, at the net profit level attributable to Reliance Industries, the consumer-facing businesses, which is Geo and retail, is only 25% of bottom line. So you're really, in a sense, getting a relatively small business with very high expectations when the core business is oil to chemicals, and within that you have really had disclosure levels falling sharply. So I think that's the reason why the market pummeled it yesterday itself, or was it day before? Sorry, Monday.
Right. Jal, how do you read the explanation from the management for the changed norms of reporting the petchem and refining segment? In terms of, were you satisfied with what the management had to say? Did your clients probe at all regarding this issue? Were there any questions raised?
So I think rightfully from the management's perspective, they're really looking out over the horizon significantly. And what they are strategically decided, and rightfully so, that they want to focus more on the chemicals and petrochemicals part of the business, the value-added part of the business. This is going to be a growing business. And also to that extent, the carbon footprint will reduce. And they have, very significantly essentially stated, and a very bold target at that, and that's actually credit to them, that by 2035, they are looking to have zero be carbon neutral, basically. So basically, they are attempting to steer the market more towards, what matters in the longer term. So I would say from a long-term perspective, they're correct from that thinking. But I would really think is that once that process is significantly down the road, and they've demonstrated that rather than saying, hey, look, stop looking at the biggest business suddenly, and we are telling you that, look at now the petrochemical business, look at the integrated business. I think that's the folly. What needs to be done is essentially you demonstrate that you are getting into value-add businesses rather than just saying stop looking at that intermediate business altogether, basically.
Right. Jal, but the fact of the matter is, whatever be the earnings, I don't know whether it merits the 7% fall that you've seen, 5% on Monday, another 2% today. Given how much under pressure the rest of the market is and the fact that FIIs have turned, sellers the last 3 days, maybe we could see some more pressure build in the markets. Who knows? And Reliance is going to fall further. Do you think time has come yet, as I see just about defending the 1900 rupee per share mark, to buy into the stock yet? Or would you say wait it out? We could see lower levels and then it becomes a buy.
So we've reiterated our downgrade and waited out recommendation effectively. Because, let's not forget that while Reliance has underperformed the market very sharply in the last 6 months, it did lead the increase, and not only led the increase just prior to that till about June, July of 2020. But for the last 4 years, it's been an excellent performer. And to that extent, actually, a bulk of the bulk of the stock increase has been a valuation increase. So on a very rough reckoning, the stock has gone from a PR of roughly about 10 times 4 years back to a little less than 30 PER. So that's really because the market, from being an extreme disbeliever 4 years back that Jio is not going to succeed. 4 years back, the market was giving a 50% discount, 30 to 50% discount to the invested capital. 2/3 of the invested capital was debt. Now, if you give a 50% discount to the invested capital, you're not only saying that equity value is zero, but 25% of the debt is going to be written off. Now, the reason I'm telling you this is because it's really the investor's mindset which has changed dramatically. The fundamentals have, of course, improved, but the investors have gone ahead of themselves. I mean, they've bumped up the valuations threefold, and really the ask for growth is extremely high. So therefore, we feel that more realistic levels are what we would be looking for in terms of valuations.
Sum it up, what's the outlook on Reliance Industries when it comes to earnings growth? What is it that you're penciling in, and what's the outlook on the stock in the long haul?
So, despite recent earnings pressures at the EBITDA level, especially because at the net level they've done reasonably well because of almost zero tax and lower, greater investment income. But I think in the sort of medium term, they should have a fairly healthy earnings growth. I mean, I'd say somewhere in the teens, and perhaps even the higher teens, basically. So I don't think that's, while there's potential for some risk there, but at the same time, they have commissioned huge capacities, right? And that is what now is, there's an operational leverage which is kicking in any case, maybe in the form of a $6.5 billion petcoke gasifier. They've just started commissioning a $6 billion upstream business, which may add $1 billion per year or more in terms of EBITDA. And of course, the retail side of the business also, their brick and mortar business, after 13, 14 years of actually building that business now is at an operational leverage phase. So I think earnings growth in the medium term is going to be reasonably good. Especially in the context of the market. And if I remember correctly, even the past 5-7 years, Reliance's actually earnings growth has nearly grown at twice the pace of the market earnings growth. So that's not really been an issue. The issue is really the growth expectations, as I mentioned repeatedly, of the retail and Jio business has gone to 30% CAGR ask. And at the cost of repetition, notably, the retail business and the digital services business are only 29% of net profit attributable to Reliance. I'm not talking about EBITDA. In the EBITDA line, the way accounting works is you capture 100% of these businesses in part of the consolidated EBITDA, but Reliance only owns 67% of Jio, the geo platforms, and 85% of retail. So you got to adjust for that at the net profit attributable level. So it's actually a smaller business where the market is expecting huge growth. That is really what is the stock price driver. Look, frankly, the fundamental thought, I mean, this goes back to textbook theory, that valuations tend to drive up stocks more than earnings. And this is really a classic textbook scenario of that, basically.
It's been a pleasure having you on board. Thanks much for just giving us a deeper analysis as to what has been the outlook when it comes to, this retail disclosure norm for Reliance Industries and how the street should be looking at